All right, let's jump right into today's explainer because we have got an incredibly fascinating paradox to unpack. We're looking at a highly profitable software company that's suddenly facing a massive reality check from Wall Street. The company is Blackbaud, and going into the first quarter of 2026, they are absolutely firing on all cylinders. Yet, they find themselves caught in this really wild tug-of-war between their own impressive profitability and the somewhat sluggish growth of the sector they're in.
Right out of the gate, we're seeing immense confidence from the top. Chad Anderson, Blackbaud's CFO, lays out what we're going to call the ultimate bull case. Management clearly sees a company executing perfectly against its operating plan. They're throwing off cash, and they are adamant about delivering long-term value. Sounds pretty great, right?
Well, to really understand these claims, we first need to look at the engine itself. For those of you who might not be familiar, Blackbaud, trading under the ticker BLKB, is the world's leading provider of AI-powered software solutions specifically built for social impact. We're talking about the tech that powers nonprofits, educational institutions, and corporate social responsibility programs all over the globe. Moving into Section 1, the social impact software giant, powering nonprofits at scale. Let's break down exactly how this company monetizes such a massive and fragmented market. Because honestly, to understand their financials, you've got to understand their revenue engine. And it is quite an engine. Blackbaud possesses a truly enviable recurring revenue stream. Just think about this. 64% of their revenue comes from contractual software subscriptions, and another 34% is transactional recurring revenue, which is mostly donation processing and payments. That means a staggering 98% of their business is recurring. Only 2% relies on one-time services. It's almost entirely locked in. So what keeps all that recurring revenue so safe? It's an incredibly sticky product ecosystem. Blackbaud boasts customer retention rates of over 90%. They pull this off with a relentless product-first approach, rolling out AI capabilities to empower these nonprofits, and, crucially, embedding deep cybersecurity to protect all that sensitive donor data. Once an organization is plugged into the Blackbaud matrix, they rarely ever leave. Which brings us to Section 2, Q1 2026, firing on cylinders. Strong guidance reaffirmed. How exactly did all this sticky, reliable revenue translate to the beginning of the year? Let's check out the hard numbers that have management so fired up. They just reaffirmed some massive full-year financial guidance. We are talking about top-line revenue pushing toward $1.18 billion. But the real magic is further down the ledger. Adjusted EBITDA is expected to clear $430 million, and they are projecting nearly $300 million in free cash flow. Just so we're all on the exact same page here, non-GAAP free cash flow is basically the actual tangible cash they generate from their operations after they've covered their necessary investments, things like software development and equipment. It is literally the lifeblood of financial flexibility, and Blackbaud is generating an absolute ton of it. In fact, in their latest yearly earnings release, they delivered a statutory profit of $2.37 per share. That modestly beat analyst expectations and proved there is some serious financial muscle under the hood of this operation. Let's move to Section 3, the profitability playbook, engineering margin expansion. You see, the true story of Blackbaud isn't really about how much money they make, it's about how much money they keep. They've managed to engineer a massive margin expansion over the last few years. Back in fiscal year 2020, their adjusted EBITDA margin was sitting at 26.5%. By 2025, they pushed that up to 35.9%. That is a 940 basis point jump. And they aren't stopping there. They have a clear trajectory to push that margin past 40% by 2030. Now, they didn't just stumble into these high margins. They actively manufactured them through some ruthless, disciplined execution. They drove headcount efficiencies, aggressively consolidated their data centers, drastically shrank their physical real estate footprint, and continually migrated their infrastructure to third-party clouds. Essentially, they trimmed the fat to build a highly efficient profit machine. Okay, Section 4. Capital allocation and buybacks, manufacturing shareholder value. The absolute crucial question here is, what do you do when your company is throwing off hundreds of millions in free cash flow with ever-expanding margins? Let's see how they allocate that capital. They use it as a weapon, specifically a weapon to drive shareholder value. As of March 2026, Blackbaud had a staggering $878 million remaining in their aggressively reauthorized stock repurchase program. They're taking their mountain of cash and using it to buy their own stock right off the market.
This huge cash reserve allows them to execute a distinct three-step capital allocation strategy. Step 1, clearly, is those stock repurchases. They've already shrunk their outstanding shares by 13% since late 2023, and they're planning to buy back another 5 to 10% this year alone. Step 2 is responsible debt management, keeping their debt to EBITDA ratio below 2.0x. And step 3 is targeting smart, high-synergy M&A in vertical markets they already dominate. And now for the pivot. Section 5, the analyst reality check. Wall Street's growth warning. Up to this point, the story sounds completely flawless, right? Sticky product, expanding margins, massive cash flow, huge buybacks. But let's dig into the data highlighted by Simply Wall Street and look at the stark reality check the market is pricing in.
Here is the absolute core of the paradox. Despite all of that brilliant financial engineering, Blackbaud is projecting a rather sluggish 4.1% annualized revenue growth rate. Historically, over the last 5 years, they grew at 5.4%, so it's actually slowing down. Now compare that 4.1% to the 15% growth expected from their industry peers. Blackbaud is trailing massively behind the wider sector when it comes to top-line growth.
And this is giving analysts a major headache. Because of the aggressive buybacks and the margin expansions, per-share earnings are actually expected to jump 25% to $3.13 next year. Yet that slowing top-line revenue growth led to a brutal 22% cut in their consensus price target, bringing it down to $59.80. Think about that. Earnings are going up, but the valuation target is going down. When we look at the range of estimates, you can really see the varying degrees of pessimism out there. The most optimistic target sits at $74. The consensus is just under $60, and the most pessimistic values the stock at just $50. Simply Wall Street openly calls this out as a clear warning sign regarding the company's long-term intrinsic value, especially when you hold it up against its much faster-growing software peers. So let's synthesize all of this. Here is the bottom line. We are looking at a phenomenal margin expansion machine. EPS sentiment is undeniably improving because they are intentionally shrinking their share count and optimizing operations to the extreme. However, revenue estimates, while steady, are lagging significantly behind the modern software sector. The price target cuts reveal a deep, underlying pessimism from Wall Street about how valuable a slow-growing tech company truly is in the long run. Which leaves us with this final, incredibly provocative thought to chew on. Based on everything we've unpacked today, in today's tech landscape, would you rather bet on a slow-growing, hyper-profitable machine that generates massive free cash flow? Or would you chase the explosive, but often unprofitable, revenue growth of the broader software market? It's a fascinating debate. Thanks so much for joining me on this explainer, and as always, keep questioning the data.